the stock market, so I'm going to carry it. If emotionally, like me, you just would rather not have any debt at all, then you blow it off. Let's say I'm sitting on this pile of gold and you want to borrow some of my gold. I'm happy to loan you, Stephen, these 10 very valuable gold pieces, but I don't like you well enough to just let you borrow them for free. I want to be paid. I want to get a reward back for that. So when you return these gold pieces to me in a year, you're going to return 11 gold pieces to me. You're going to pay me 10% because an extra gold piece is 10% of these 10, right? Make sense?
Yeah.
That's what interest is.
So if I say, okay, right, I'm going to buy a house.
Right. You're going to take those 10 gold pieces. Go ahead and take them.
So I'm buying a house that costs 10 gold pieces. Right.
Many people look at the meteoric rise of Bitcoin over the last 15 years and conclude that it was a brilliant investment. But today's guest expert challenges that narrative. He argues that buying Bitcoin 10 years ago wasn't necessarily a good choice. It was a speculation that happened to pay off. It was a winning lottery ticket. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
You just made a critical point in that you can make a bad choice where things work out well for you.
Yeah, exactly. It's still a bad choice.
So a great example of that is investing in Bitcoin, right? I'm not a proponent of investing in Bitcoin. Certainly, for those people who bought Bitcoin 10, 15 years ago, they've done extraordinarily well. They got lucky. Lots of speculations don't work out that well. So if you are speculating, then it might work out extraordinarily well for you. But you're taking some pretty heavy risks in doing that, right? It's same thing with a lottery ticket. I mean, the chances of winning the lottery are infinitesimally small, but people buy lots and lots of lottery tickets. Somebody does win it, but that's probably not a good way to spend your money.
Bitcoin. You're not a fan of Bitcoin?
No. And I'm not opposed to Bitcoin existing in the world. But for me, it's a speculation, and I'm not a speculator.
When you say give me some color, because I'm sure there's some people who
Sure.
are listening now that are either thinking about Bitcoin or have invested in Bitcoin.
I mean, if you want to speculate that Bitcoin, so I would recommend against it. So people, and they might push back and say, well, but JL, you were recommending against it 10 years ago, which I was, and you've been wrong. I mean, absolutely wrong. It's been great 10 years. It's done far better than the S&P 500. Well, that's true. If you'd had a crystal ball, if I'd known that 10 years ago, I would have been in Bitcoin, right? We don't have crystal balls. So the question isn't how has Bitcoin done in the last 10 years? It's how is it going to do in the next 10 years? I don't know the answer to that, but that's the question. Is it worth $100,000 a coin now? Is it going to continue to grow at that pace that you regret that you missed over the last 10 years? That's the question you have to ask yourself.
But I could say its success is evidence that it's serving some kind of utility for some people somewhere. Its success means that there is demand for it by very nature, that the price has increased so crazily over the last 15 years.
Yeah, that's an argument that people make, and there's a lot of debate around that, right? What is the function that it has or that it's going to develop? And you might well be right. I don't know the answer to that question. It's not currently, at least, a currency because it's way too volatile to serve as a currency unless you're doing illegal things that make it more attractive than the volatility makes it unattractive. So that's not necessarily good for society, but so it can't function as a currency. So right now it's just a speculation. Is it going to grow into something that's more functional? Well, listening to one of the other interviews you did, that woman absolutely believes that that's what's happening. And then Kathy Wood, so that's why she's in Bitcoin. And she may be right, but she's speculating. And again, I have nothing against speculating as long as you understand, as I'm sure she does, that that's what you're doing.
You'd prefer investing?
I prefer to have an engine creating wealth behind where I put my money. So the mortgage one first to me is pretty easy. It kind of depends on your interest rate.
What is an interest rate?
So an interest rate is what you pay to borrow money. So when you get a mortgage, you're borrowing money, right? You're borrowing it from a bank or a financial institution, and they want to be paid for letting you use their money. And 3.5% or less, that's really cheap money. I would hold on to that. I would be in no hurry to pay that off. On the other side, if you have a mortgage rate that's, say, 6% or higher, well, when you pay off that mortgage, essentially you're locking in a guaranteed return of that interest rate, right? So if you pay off an 8% mortgage, you've locked in an 8% return on that money effectively. And then to finish the thought is, if your interest rate's between those two, like 3.5% to 5.5%, 6%, then I would say it would depend whether you pay it off or not is what makes you emotionally more comfortable. And there's value in being emotionally comfortable. So if you are comfortable carrying the debt, you might say, well, I think I can do better in the stock market, so I'm going to carry it. If emotionally, like me, you just would rather not have any debt at all, then you blow it off.
Maybe we could use the coins as an example of what an interest rate is.
Sure. Let's say I'm sitting on this pile of gold, and you want to borrow some of my gold. I'm happy to loan you, Stephen, these 10 very valuable gold pieces. But I don't like you well enough to just let you borrow them for free. I want to be paid. I want to get a reward back for that. So when you return these gold pieces to me in a year, you're going to return 11 gold pieces to me. You're going to pay me 10% because an extra gold piece is 10% of these 10, right? Make sense?
Yeah.
That's what interest is.
So if I say, okay, well, I'm going to buy a house.
Right. You're going to take those 10 gold pieces. Go ahead and take them.
So I'm buying a house that costs 10 gold pieces.
Right.
Right. So I'm going to accept your 10% interest rate.
Okay.
Am I paying 10% a year on the total?
On the balance. So the way a mortgage works is let's say it's a 30-year mortgage, you're going to be giving me a certain amount of money every month, right? That's your mortgage payment. And in the beginning, most of that payment is going to be interest to me. And a very tiny sliver of it will be paying down the principal part of the 10 gold pieces that you bought, or that you borrowed. A very tiny sliver. And then over the course of 30 years, that ratio changes as you pay down the debt, and less of it is interest payments, and more of it is paying down the principal until at the end of 30 years, you've paid all the principal, and you've paid me a fairly enormous amount of money in debt over that, or in interest over that 30 years.
And how do I get a good interest rate? How do I get a very, very low interest rate? And what is a low interest rate?
On a mortgage?
Yeah.
So the only way you can get so first of all, you're going to pay basically whatever the current interest rates are.
Who sets the current interest rates?
So the Fed sets an overall interest rate. You've heard the Fed will raise or lower interest rates, and that will influence what lenders like bank and mortgage companies will charge. It doesn't require them to do a certain level, but it will influence up or down how much they're going to expect in return for their money.
The Fed is a government.
Yeah, the Fed is a government agent, partially because the Fed is anticipating inflation by how they set interest rates. So if I'm lending you money and I'm worried about inflation, if I lend you my 10 gold pieces and say I want 11 back in a year, 10%, but inflation is 15%, well, I've just made a very, very bad deal. So if I think inflation is going to be 15%, I'm going to want 2 gold pieces back. It's maybe, or, so I'm making a profit above and beyond inflation. So going back to your question, how do you get a good mortgage rate? Well, you shop around to various lenders at the time you want the mortgage and see, who's offering what. And there'll be some variation within 1/8% or 1/4% or something. But for the most part, they're all going to be very tightly put together because they're looking at the overall projection of what inflation is going to be, what they can charge, what the cost of money is, what they can charge in interest, and then competitively what they have to do to get your business. So there's not going to be a lot of variation. You're not going to get a significantly better interest rate than somebody else. But if you shop around, you can probably do a little bit better. As some people have said, predicting what the stock market is going to do is very, very difficult. Predicting where interest rates are going to go, even more so. So I think if you're gonna buy a house, then again, you buy it based on whether you can easily afford it, whether it meets your needs at a given time, and you deal with the interest rates you have to deal with. And of course, they'll be part of the equation in terms of how much you can afford, because the interest rate on your mortgage is going to have a lot to do with how much you have to pay every month.
And it's quite high at the moment, interest rates.
High compared to what? So the first, right now, mortgage rates are 6%, 7%, somewhere in there. The first mortgage I took out was 18%. 18%. That would have been in 1979, because in the 1970s, we had really high inflation. And when you have high inflation, you have high interest rates, right? So to me, I hear a 6% mortgage rate, and it doesn't sound bad to me. But for people who grew up where mortgage rates were 2.5%, 3%, well, yeah, I mean, it's huge. It depends on your perspective. So depends on your time horizon. So stocks are the single most effective, strongest wealth building tool that's ever been created. But they are also very, very volatile. So when she says, are stocks safe to invest in right now, what I hear is very short-term thinking. And stocks are never safe to invest in for the short term because they're volatile. At any given moment, they can take a deep plunge, and that's a perfectly natural part of the process. People get all crazy, especially if you watch the news, people go insane and panicked, but crashes and pullbacks in the stock market are a perfectly natural part of the process. They're very, very difficult, if not impossible, to predict when they're going to happen. But that's the reason you never want to invest in stocks for money that you're going to need in the near term. If you zoom out for longer periods of time, which is what I recommend, stocks are stunningly reliable. I mean, there are very few times over the course of 10 years where stocks have not given you a good return. And you got 20 years, and I mean, it's very rare. So if you look long term, stocks are extremely safe and extremely powerful in building wealth, but they are very volatile along the way. So you have to be willing and able to endure that volatility. If you're going to panic and sell when the market drops, not if, because the market will drop. It's a perfectly natural part of the process. If you're going to panic and sell when that happens, you do not want to invest in stocks, because they will leave you bleeding on the side of the road. Following my advice will leave you bleeding on the side of the road if you panic and sell. It's 100% dependent on tying yourself to the mast during the storm and ignoring the volatility and continuing to invest into it, because now you're actually accumulating shares on sale because prices are down, because the storm never lasts. It always blows over and the sunshine comes back out and prosperity returns.
If you sell during a crash, you are the one who insures your own loss. Our experts' advice for 2026 is simple. Tie yourself to the mast. Ignore the volatility. When the market is down, stocks are on sale. The storm never lasts forever. The clouds will break, the sun will come out, and prosperity always returns to those who stayed the course. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.